Hello and welcome to ChartMill. Today I'm going to talk about one of my favorite indicators, the alligator indicator, introduced by Bill Williams, trader and technical analyst. He was considered to be the forefather of modern trading psychology, combined with applied technical analysis and chaos theory in trading the stock and commodity markets. The alligator is a trend indicator. It consists of three moving average lines which are used to visualize ranging and trending markets. According to the author, most of the money is made when stocks are in a clear upward or downward trend phase. The tricky part, however, is that according to his research, the markets move sideways the vast majority of the time, between 70 and 85%. This means that typical trend periods account for only 15 to 30% and that for the most part markets actually move randomly. It is therefore very important to be able to identify and take advantage of these scarce moments in order to maximize the chances of profitable positions. The indicator uses three different smoothed averages. It starts with a 13-period average, which is smoothed by 8 bars. This is called the jaw. Second is the 8-bar average, smoothed by 5 bars. This one is known as teeth. And the last one is the 5-bar average and is smoothed by 3 bars, also called the lips. When the alligator sleeps, the mouth is closed. It means that the different averages, so the jaw, teeth and lips, are very close to one another and the trend is therefore sideways or neutral. And as a trend trader, you want to avoid these kind of circumstances because the market is in a range. If the alligator is awake, the mouth is open and the beast is hungry. So the different averages are in perfect sequence, representing the open jaw of the crocodile. If the jaw, teeth and lips are far away from each other, the trend is considered strong. The trend is clearly positive if price is above the averages and all three moving averages are rising with the jaw at the bottom, the teeth in the middle and the lips at the top. And we refer to a convincing negative trend if price is below all the averages and the averages itself are descending with the jaw at the top, the teeth in the middle and the lips at the bottom. A trigger signal is established if the lips are crossing the teeth and jaw. If the lips are crossing the teeth and jaw upwards, it is a bullish signal. If the lips are crossing the teeth and jaw downward, it is a bearish signal. Simply buying when the trigger signals occur is the quickest way to go broke. This is because the alligator indicator, like other trend indicators, is a lagging indicator. And by the time a bullish signal occurs, the price will have already made a significant move. Since the markets move sideways for the most part rather than being in a clear trend, the number of false signals will be considerable and so will the number of loss positions. So let's take a look at three possible ways to make the indicator more reliable. The first way is to use the indicator as a warning signal for breakout setups. So when the alligator wakes up and gives a bullish trigger signal, look for the nearest significant resistance level. If the price can break through that resistance and the different moving average are still in the right order, that is the moment to take a long position. For the stop loss, you can use the ATR indicator. Set a stop at least at 2 ATR. More information on why the ATR indicator is very suitable for determining your stop loss can be discovered in this video that is now appearing. I will also leave a link in the description below the video. When considering these types of breakout setups, pay attention to the trading volume. It can give you some important clues about how interested investors are in this stock. In particular, if the volume rises just before and during the actual breakout, that's a good sign. Let's take a look at some other charts. XOP is the perfect example to show that simply buying based solely on indicator signals is a bad idea. In this ETF there was a bullish signal on the date of January 13, but the price bumped into resistance and fell back. Probably this would stop you out with a long position. However, the price broke through the existing resistance in a convincing manner and with strongly increasing volume at the end of February. That day almost closed on the high of day, and price would have never been near the initial stop loss. The same thing happens at MCK. First, there is a bullish trigger signal, and few days later the price opens with a gap up, above the existing resistance. Next, an impressive rally kicks in, taking the stock from 215 to a top of more than 335 in about 6 months. The same goes for price declines, when the price finally falls through an important support. Take a look at ticker IAA. The alligator indicator gives a bearish signal, followed a few days later by a longer red candle that closes below the $52 support. This is the beginning of a significant price decline with a current bottom at $32. The indicator can also be used as a tool for retracement setups. This involves trying to open a position in an already existing upward or downward trend. This setup often occurs after an initial breakout, which provides opportunities if you missed the first one. If the trend is bullish, all three moving averages will point upwards with the price above it. As soon as there is a slight price drop to the green or red line, a long position is considered, assuming that the upward trend will resume. This is also possible in a downward trend. If the price rises to the green or red line, a short position is considered, speculating on a further continuation of the existing downward trend. Wait for confirmation signals before opening a position. Just because the price falls to near one of the moving averages does not mean you can automatically go long or short. An important condition for long positions is that the volume of the temporary downtrend should be low. Again, look for additional elements that support your setup. For example, the presence of existing horizontal support or resistance levels, or the presence of typical candlestick patterns or formations like a bullish hammer candlestick or a bullish engulfing pattern. Rising volume as soon as the price resumes its previous trend. And the more additional elements present at the same time, the stronger the setup will be. Finally, we can also use the indicator as part of a counter-trend and reversal strategy. This is by far the most aggressive way to use the indicator, but it is also the most rewarding if the setups play out as intended. Instead of waiting for the classic trigger signal, where the green line crosses the red line upwards and then the blue one, a position is taken based on the price movement. First, we consider the position of the different averages. For a bullish setup, the green line should be below the red line and the red line below the blue one. The greater the distance between the different lines, the stronger the existing downtrend. As soon as price closes above the red line, a long position is opened. For a bearish setup, it goes as follows. The green line is above the red one and the red line is above the blue line. As soon as the price closes below the red line, a short position is opened. This method is interesting if you are willing to use wider initial stops. Do keep in mind, however, that the margin of error with the latter method will be quite high. After all, you are taking a position early on that goes against the prevailing trend. Each of the three ways I have shown here has its specific advantages and disadvantages. You can choose the one you prefer, but you can also use them together in a specific strategy where you increase your position as the price evolves in the direction you want. Consider this example in the Targa Resources stock. In late 21 and early 2022, the price closes above the falling red line. An initial small long position is opened as a test with a fairly wide stop. After all, the trend is still down if we look at the smoothed averages of the alligator indicator. The price initially continues to rise but experiences price pressure at the level of the first resistance. Price drops back a bit and bottoms out at the level of the red rising line. An additional long position after this specific candle would have been possible, although the risk reward with a stop loss just below the candle and taking into account the existing resistance level is not really very good. At the end of January, however, there was a clear price breakout where the long position could be extended again. The price decline in the second half of February offered no real buying opportunities, but that was definitely the case in mid-March where the price dropped to the level of the ascending red line. A Joji candle formed with a relatively small body and a significant undertail. All three moving averages were still in perfect order and confirmed the existing bullish trend. This allowed the positions to be extended for the third time. The upward trend continued until mid-April, when the price suddenly fell very sharply, closing even below the red line. Initially there was a slight recovery, but when at the beginning of May the green line crossed the red line downwards, it was time to close the position or at least adjust the stop loss in such a way that a large part of the accumulated profit could be secured. Of course, this is a well-chosen example of a stock with a perfect trend. In reality, it will be rare for a stock to trend like this, but that is not necessary either. If you have just a few of these big ones in your portfolio where you can build a small test position into a full position, that is more than enough to compensate for many other small loss positions or break-even trades and still get a very substantial return. So there you have it. That concludes this video. If you found the video useful, don't forget to give us a like and subscribe to the channel. See you next time.